everyone proclaimed that this was the end of the stock market. But for now, all I can say is this is just a beginning.
Stock markets around the world witnessed one of the biggest sell-offs in history during the month of March 2020.
The stock market moved well below that. Right now, it looks like the Dow is down by about 6.9%.
People all around the world were pessimistic and claimed that we were on the verge of experiencing the worst economic depression in the history.
We are going into a global recession.
We're in an economic downturn.
The world is now in recession.
Recession in the next quarter or two because everything is shutting down, of course.
An extraordinary disruption. It's almost like a meteor hit the entire planet. And we have to now deal with the fact that we've been knocked off our axis.
Panic, hopelessness, and unemployment were all rising at the same time. Retail investors believed that the stock market would never recover and that there would be a massive recession. Until the US Federal Reserve announced its first pandemic relief measures.
The World Bank has approved a funding of $12 billion to developing countries for financing the purchase and distribution of COVID-19 vaccine tests and treatments.
The Senate did unanimously approve an historic $2 trillion relief bill meant to ease the economic pain of the coronavirus. It offers hundreds of billions of dollars to big companies and small businesses, along with cash payments to many Americans.
As a result, the stock market began to gain momentum. The relief kept coming. Nearly 20% of dollars in circulation were printed in 2020. All major banks followed the Fed's lead. Indian Central Bank stimulus was equal to 6% of GDP, 4 times the average of emerging markets. Stock market soared as a result of this. The overall upward trend was sentiment driven and not coincidentally. Globally, all governments and central institutions, including the Federal Reserve and the European Central Bank, have supplied with abundant cash to stimulate growth, which has maintained the euphoria. From the March close of 7,500 levels on 9th November 2020, the Indian stock market index Nifty reached 12,300 and closed above 12,400, which was the index all-time high. For the first time in the history of Indian stock market, the move was greater than 60% and a 4,700 points move within an 8-month period, which I would say is unbelievable. The domestic rally was backed by strong global cues. The market remains bullish with gains in sectors especially automobiles, information technology, and metals. The improving domestic environment facilitated sustained entrance of international institutional investors into the country. Analysts recognize that India is on the threshold of a boom cycle, with earnings momentum picking up in the fourth quarter, and government capex-led expenditure will give further revival in the economy. The fact I'm about to say may seem impossible to you, but from the March lows of 7,500 levels, the Nifty has not only crossed 12,400 levels, but also have closed above 18,000 for the first time in history. It was a 45% move and a 5,500 points covered within a span of just 11 months from 12,400 levels, which was an incredible bull run. So what was the reasons behind the market's rise, and what are the most important factors? The bull run in the domestic markets has been aided by a large number of IPOs, low interest rates, and liquidity. Analysts predicted that both market indices would set new highs as investor optimism remained high in the wake of good quarterly results from leading corporations. The RBI's monetary policy stance is also the most critical element driving the surge in domestic stock markets. The stock markets will continue to gain momentum if the central bank maintains low interest rates. Following the crash, many industries such as IT, metal, and pharma performed well. As a result of all these developments, international institutional investors have begun to place bets on India's market expansion. According to Bloomberg News, net inflows from institutional investors this year have totaled around $7 billion, making it largest among the Asian emerging markets. Another factor that supported the spike was the influx of new retail investors into the stock market. Apart from causing an economic slowdown, the pandemic has attracted a large number of new investors to the country's financial markets, sparking an unprecedented buying frenzy. The COVID-19 outbreak brought the economy to a standstill as business suffered and jobs were lost. The share market offered a chance to supplement income in such times. The lockdown gave people to think and understand the market and invest. India's youth demography is fueling an investment boom in the country's investing environment, as millions of people have poured into the stock market during the lockdown. In the current scenario where interest rates are going down, many people also looked at equities as an alternative investment. Increasing digitalization is making it easier to open Demat accounts and invest from the convenience of one's home. The ease of opening a trading account, seamless mobile platforms, and above all, the availability of cheap internet is further encouraging retail investors to dabble into the stock market. Further, low-fee trading platforms are also attracting huge participation, especially the day traders. According to SEBI statistics, close to 6.3 million new Demat accounts were created during the April-September 2020 period, an increase of more than 130% compared to the same time last year. Of the country's new accounts, the vast majority were opened by millennials aged 24 to 39, according to separate data from the market regulators, the Securities and Exchange Board of India. India's various and growing online investment platforms have also seen a surge in demand. Zerodha, India's biggest trading platforms by client numbers, now claims to handle 5 million to 7 million orders per day compared to Robinhood's reported 4.3 million transactions daily, which is insane. But how could the rally be good to retail investors and young traders who are just getting their feet wet in the market? Everyone should be aware that these kinds of corrections are extremely rare, and these kinds of corrections provide you with once-in-a-lifetime opportunity to buy good businesses at cheap price. So this was a great opportunity for long-term investors who are planning to invest in these companies. Buying excellent businesses for a cheap price may provide you with extraordinary returns in the years ahead. For example, if you had bought the shares of Tata Motors for long term in the March lows, back then it was just priced at 70 rupees. The stock has reached a high of 500 rupees within a 20-month period. The stock has risen by 600%. That's a 600% return on investment. Just imagine the kind of wealth created here. No bank or any other organization can offer such a high return. This is the power as well as the beauty of the stock market. You could also take positional trades in the stocks that were trending. A positional trade is when you buy and hold a financial instrument for weeks if not months until your target is hit. If you didn't want to buy and hold stocks for longer periods and just wanted to trade short term for a lot of money, then you were made for these kinds of positional trades. Now, as an intraday trader, during those periods, the markets were extremely volatile with clear trends. Intraday trading is a practice of trading stocks or any other financial products within a single business day. You exit your positions before the closing bell, thereby booking profits for that single day. This is how you could have benefited from the bull run and made money in the markets in a variety of ways. Getting into the markets and making a profit through trading have never been simpler, thanks to the advancement in digitalization and technology. Remember that the market has something to offer everyone, regardless of their financial situation, age, or educational background. So make the maximum out of it.